Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Good morning, everybody, and welcome to the call for the 4th of July. So hopefully over the next half an hour or so, we'll have lots of interesting stuff for you to discuss. Now, as it's the call after the end of the quarter, we're going to do it slightly differently, with Piers going first with his technical outlook, and then I'll follow up with the fundamental outlook thereafter. So Piers, without further ado, I'm going to hand straight over to you.
Hi, I'm going to go through the technicals and I'll kick off. We've got a lot of charts today. Why do I simply look at price? I don't look at the fundamentals. I think it's because a lot of people are under the misconception that I've said before, that markets and events are random, driven solely by fundamental laws and news, meaning you can't predict turns and anything like that. My 40 years in the market, 40 years looking at markets tells me otherwise. You know, charts have been around a long time, and I think the charts show that markets are driven by mathematical order and history. Retracements and cycles like that happen time after time. So hopefully in this presentation, I'll be able to show you that. So we go off to the first slide. This is the dollar index quarterly. So here I take the whole move lower from 1985 to 2008. We see that move down, and then I look at the retracements coming back on to see if they can help us where the market will stall and see what's happening. You know, the first thing you can see is that since 2008, you have higher highs and higher lows. So the dollar uptrend is there. The dollar is getting stronger. It's slowly going up and down, but slow and steady, but surely going higher. So if we go to the next slide, I'm going to zoom in because it's hard to see that, and just show what I talk about, this mathematical order. So in the level I talk about a lot, and if you've been on these calls before, it's the 38.2%. So you can see now here that for 4 quarters, not all in a row, but every time it's been up there, since 2023, every rally in the dollar has been capped by the 38.2% retracement on the dollar index. And so that's very important level. 106.60, I highlighted this last quarter, and I said we can use it as a pivot at the moment. If you want to see dollar stronger from here and you think the dollar's going to strengthen, it has to break that 106.60. Then we can look for a move up towards maybe the 110 area. While it's below that 106.60, it hasn't quite got that trigger, and we've seen tests back down towards that 20-period moving average, which is around about 100. So that's why I talk about the mathematical order. You see moves towards that pink line, order. You see moves at the green line, stopped. You know, is that mathematical, or is it just coincidental? Fundamentals come out at the same time. I'm not sure. But anyway, so if we go to the next slide, this is something else we can look at. We can look at where price in relation to the Ichimoku cloud, which is basically a historical lagging moving average. Price is above the cloud, so we've stayed positive since you've broken out of that sideways triangle, the blue lines. We've had a move up. We've come down and we've tested that 100 area again, which is roughly where that pink moving average was. So we know where support is for the dollar. It's 100. We know the pivot is 106.60, and we know that if it breaks above there, praying up towards that 110 area where the resistance comes in. Just below and above that, there's 2 different areas. But one thing is sort of I think just a bit cautionary here, is the lagging line had a strong move up, the black line there, and I've written next to it lagging line. It came down, it rallied up again. It hasn't really broken through the last high. And I'd really like to see that happen to get some more confidence on the dollar doing another strengthening. Because while it's here, you have that slight risk that it might be fatigue and price might just fall back to test the 100 area. But anyway, keep watching the webinars and I'll keep you up to date with this chart and how that's going. But just to summarize what I've just said there, 106.60 pivot. Below that, your range is 100 to 106. Above 106.60, then you sort of get a 106.60 base up to 110, but we haven't got that break quite yet. So if we go to the next chart, we're going to start looking at the currencies themselves. So this one is the long-term euro-dollar quarterly chart. And I have this on each quarter. I find it very good just to know where you are, big picture. You know, again, this is a lovely chart. I like that you just look, there's a trend line. It held from 2000. When it broke below, it came back, tested it. You know, this suggests to me mathematical trend lines have importance. But, you know, maybe it is fundamentals. But I'm just saying that here, it looks like to me, you've come off that trend line. We've had another negative quarter, last quarter, off that trend line. So that's where we are on the trend line. You're sort of coming off there. But is there a way we could tell where the bottom was going to be euro dollar this quarter? Yeah, and we covered it last time on the webinar, on the quarterly webinar. There is a way. And if we look at the next slide, here we can look at the retracements. So the retracements for the whole move down from the 160 down to the 95 area. So that's the moves we're looking at. And you can see that trend line still on there. Now, let's zoom in. So on the next slide, I'm going to zoom in so you can see a bit closer. This is the last bit of that chart. And this tells us everything. It's very good for telling us where euro dollar is. We had the move down. We knew where the base was, down that 95.37 area. You then rallied off there and you got to 112.77, the trend line, that black dash trend line. So where do we look for? We looked at it on the other one, 38.2%. It tells us if the trend is intact, so the move higher is intact, the move higher, the impulsive move higher is intact as you've held the 38.2%. If it breaks 38.2%, that's where things change. The buyers have lost that edge and you'll start to see price slide down. But where's that? 106.12. And again, I talk about this mathematical, how the markets are mathematical. So for here on euro dollar, we've had 1, 2, 3, 4, 5, 6 quarters where that area, 106.12, it hasn't managed to get down and break and hold below it. It's tried testing below it, but it hasn't. So we know where the low is. That's where the buyers are. And what's capped it on the top side? 110.72. That's the 23.6%. And above it now, just coming in to join it at this area, the 20-period moving average at 110.80. So it's quite simple here, euro dollar, if you're looking at the long term. 106.12 is your support. If you start to break below that 106.12, then things are changing and you're going to start to see euro dollar head lower. If euro dollar can break above the 110.70.80 area, you know, that's positive. Price is starting to move up. You've still got that sort of trend line that we're talking about to retest, but it's going to be very positive to get above that 110.70, 110.80 area. What do I like about that? That's like a 5-cent range to watch on a quarterly chart. So that's great. That's a very tight range. Some of the things I show you will have much wider ranges. So nice tight range there to watch on euro dollar. It's what I've called my favorite market. When you get a sideways trading range like that, you know where to sell it, you know where to buy it with a tight stop either side. But just be careful of the break, because the break must be coming. This can't go on much longer, I don't feel. So the next couple of quarters, I would expect some sort of attempt to try and break out that range. I think the other thing to say is that as this month goes on, you've just finished the quarter, I would watch out mid-month. Usually mid-month after a quarterly close, everyone sort of sorts himself out in the first week or two, but by mid-month, that's when I'd expect to see people start to say, right, now I'm going to try and do this or that. So just be a bit wary mid-month on this one. So we go to the next slide. This is sterling index. I mean, you know, talk about mathematical order. If you traded sterling, this thing has helped you since 2016. You know, it's just been perfect. We had the 38.2% retracement, capped the rally for years. It capped it from 2017 all the way to 2023. 2023, we broke above it, and I sent out a warning as it was happening. And what happened? The rule of polarity. So it just simply switched. So it helped you again, because suddenly you knew where the base was going to be. So when on pullbacks on sterling lower, that's where people bought it, the 38.2. You had 3 quarters where it acted as a base. Then it sort of slightly went up, and it didn't have much of a quarter last month. There was hardly anything. It opened and closed the same level. So it's sort of showing fatigue. And I think the reason for that is because you've broken the 38.2, the target's the 61.8, and you can see you're above the 50%, starting to test towards that 61.8%. And that comes in at 69. So you're nearly at 68. So when you enter the 68s, that's going to be where the risk reward starts to change. It's very simple to know down at that 38.2, you buy sterling, it's going higher. But when it starts to get here, your risk reward starts to not be so great. You're buying it at 68 with the risk of getting to only 69. So maybe start to see it slow down as it arrives at the 68, 69 area. Where does sterling start to really change? Well, it's that 38.2, that 64, 65 area. You've got the 20 period moving average coming at the same area. So if sterling was to get back below that 38.2 and the 20 period moving average, just about aligning up now, then you know people have changed their mind on sterling and sterling's back in trouble. So how does that go into the currencies? Let's look at the next slide. So this is sterling dollar. So on the last quarterly charts, I also included this one because I think this is all quite important at the moment. The monthly chart, and I've done this on the monthlies as well, webinars, that you have this down trend line, that black line going across. And you can see as it's gone, it's always held it all the time. In fact, let's zoom into the next slide. You'll see clearer what I'm trying to talk about. So here you can see the 61.8% was 127.58. So that area was capping the market. But 2 months ago, you broke above that trend line. And then last month, you retested back to the trend line, which is acting as support, the rule of polarity. We know old resistance changes to support. And this month, we're starting to rally off that trend line. So while you're above that 125.10, which is the 20 period moving average, the pink line, and above that trend line, the pressure is going to be on that 127.58. Now, I had this on my daily charts. If you watch my daily charts, I had about a move coming to 127.50. That's where I was getting this 27.50 from, this 61.8%. So if you start to get above that 27.58 on a monthly close, then you know, the 129s is the next sort of big target up there. So it's an area worth keeping an eye on, definitely here on this one, because it suggests at the moment, while you're above that 125.10 and the trend line, that the move could be coming higher. But you haven't got confirmation yet. I'd want a monthly close above 127.60 to say, look, we've cleared that 61.8%, we're going higher. But keep an eye on that as the month goes on, and I'll keep you updated. So if we go to the next chart, this is the quarterly chart. So this is what we're doing this month, the quarterly charts, but I just want to show that cable one because I think that's quite important. So what I want to show on this chart is where it moves, the moves come from. So it starts at 211.66, goes all the way down to sort of the 103 area. Then I stick the retracements on. All very mathematical, nice order, like I was saying at the beginning of the call. So we go to the next slide. I'm going to zoom into the last bit because it's hard to see on there. So this is the current bit that we're looking at, price action now. And how nicely mathematical is this? This is like euro dollar. You have two simple levels to watch, and that's it really. So we had the move off the 103, and where did it go to? It went to the 23.6. The 23.6 is 129, and that's why I mentioned it on the monthly chart just now, saying, you know, you could see a move towards 129. So 129 has capped sterling dollar for the last 1, 2, 3, 4, 5 quarters. So it's over a year. That 23.6 is where the market sold it. It's not confident to go much further than that. But what's happened on the retracements back down? Where has been the base? The base has been the 38.2% at 120.75. You'll see that every touchdown there, the market bought. So the buyers are still there. Now, for the last 2 quarters, you haven't really tested and held down near that 38.2. They're banging at that 23.6%. So on a quarterly chart, we want to watch 129. Are we getting a quarterly close above 129? Is something happening there? So Last quarter on the quarterly charts, I said, look, watch that resistance in the 128.50, 129 area. And the actual high last quarter was 128.60. So it worked really well again. But what would I say here? I'd say, look, the risk is you're still banging at that 129. So still watch that 128.50, 129. If we start to move back down, you know where the support should be on the quarterly basis, around that 120.75. On the monthly chart, we've got 125, which is a bit closer. If you start to say, oh, that's 10 figures away from the 129. Sometimes they're wider ranges, but you just have to live with what the market trades. The market on cable seems to be liking for the last year, just over a year, support at 120.75, resistance at 129. You have to live with what the market trades. Break outside those two is really significant, and I'll keep you posted on these. And that now nicely leads us on to the next chart, which I thought I'm going to do this every quarter because someone asked about this last quarter. What about this quarterly? What about the cycle? You know, every 8 years, we've seen the market have a negative year on sterling dollar. Now, at the moment, on the face of it, sterling dollar's going up. And the point I'd say is that you have to respect the price action. So if price gets above that 129 and starts to go higher, it looks harder for that yearly chart to be negative this year. But if it gets below, if it stays below 129, then it's more and more likely, especially if you get below the 120.75. But I'll keep you posted as the year goes on. But don't sit there and just say, well, look, I'm not doing anything because this dollar yearly chart says cable's going down. You have to watch price. Price is king. A cycle is a secondary indicator. So we'll next go to the next chart. And these are the final currencies I'm going to do. Now, Neil always likes me to do sterling euro, but I'll cover it quickly because reading about sterling euro is a bit like reading a Winnie the Pooh novel or an Alice in Wonderland story. It's a nice story when looking at the basics, but it's not reality. It's not what's traded in the market. So it doesn't give you the real levels to watch. And for that, we need to look at euro sterling. And I'll go to that chart in a minute because you'll be amazed at how simple it's been. If you watch euro sterling and then just switch the levels round, convert them through, you'd have a much better track record than looking at this chart. But anyway, looking at the sterling euro chart, the one thing we did point out on here was we broke the downtrend. And we highlighted that where that black arrow is and price has gone up. So that's good. So I said last time that support should be in the 115 area and resistance in the 117.20 followed by 118.50. And we got up to that sort of area. We closed at 118.05, having briefly tested 119. So that it's sort of working, and above that 121 on the sterling euro chart. But I'm not a great fan. I can see here 115, 116 should be where the support is. But let's go to euro sterling, because if you look at this on the next chart, everything comes crystal clear why everything's stopping where it is and where it's trading. So this is the move from 2015, when we're down in the 69 area, up to the 93 area. And then we put those retracements. And if you look at the green line, I put it in green, the 38.2%, you can see you haven't had a quarterly close below that 84. But look how many tests there have been on that 84, which is 38.2. Whereas if we just go back a slide and look at that sterling euro slide, so we can go backwards, yeah, look at that. It's never even got to the 38.2. So that's what I'm saying. It's good for a bedtime story talking about sterling euro, but it's not reality. So if we go down to the next one, yeah, and then, so that's, yes, and this is reality. So this is zooming into the last bit, and this really helps show where it's trading, you know, sterling in relation to euro. So I put the large red arrow because that covers in 2023 where price broke back below the 23.6% retracement. It tried breaking above it, it couldn't hold, and then it fell back below that. So then for 4 quarters after that, you had the high was literally that 23.6 or the 20 period moving average. So those two lines have given you the high that euro sterling's got to. So the lows in sterling euro. We had that trend line, and look, that gave you the low, the trend line for the first three where I've got small arrows, the two blue and the pink arrow. If you look, if that acted as support. So for those three quarters, you got where the low was going to be, or the high in sterling euro, but it gave you the low in euro sterling. Then something I mentioned last quarter was we'd broken below the trend line, we'd gapped lower. Look where the resistance was. The resistance was the old trend line. It sort of tried going above there, but didn't get through that 20 period moving average. But this is the bit I like the best. Where did it stop? 84, the 38.2%. Now, if you get my daily charts, I started putting, as price was coming down there, I started to put, this is where the long-term buyers should be interested. And okay, it went 5, 10 pips lower below that, where the short-term people were still selling, not realizing this is where the long-term people come in, but you rallied off that 38.2%. So what do we know now? We know 38.2%, 84 is where the support should be. Where's the resistance? Well, that 86.68 and the trend line, you'd imagine that should be the resistance. And where would I get concerned that this move lower in euro sterling, or let's say the move higher in sterling euro? Where's that changing? Above 87.47. If you've got a quarterly close above there, then the market's completely changed its view, and you have to be aware of that. And it's nice just to have a level rather than something else. That 23.6, you'll have taken out the trend line, you'll have taken out the 20 period moving average, and the 23.6%, all of which for the last year have acted as resistance for each quarter for euro against sterling. So that leaves us just with one level on the downside, 84. So what happens if we break that 84? Well, if we break that 84, we could probably see moves down towards the 82. On here, the lower Bollinger Bands coming in around 82.67. But I sort of have levels before that. I sort of think maybe you might sort of find some support in the 83.50 area. But it's one just definitely to keep an eye on. I would say maybe 83.25 and 82.60 would be the areas I'd look for if it got below 84. But we haven't had the quarterly close below there, but it's a key level to watch as we go forward. And that's, I think there's no more slides. I think we go to the next one. It's the health warning. Yeah, that disclaims me of everything. But hopefully you found that interesting. If any of these levels or studies interest you and you want to chat through them or talk to your sales contact, and we can arrange a chat. But that's me done. Over to you, Neil. The only thing I do hope on that euro sterling is that Neil's probably going to spoil it now and say there's some big event in Europe or some big event in UK coming up this quarter.
Well, I'm not sure I could spoil it, Piers. No, that was a very comprehensive view through the charts now that we've gone through the end of the quarter. So thank you for that. I'm going to delve straight into my presentation. So if we go beyond the content slide and move on to the next slide, look at this is the IMF's numbers. Number of these forecasts are already out of date because we've had updates to the numbers here, but it shows that as far as growth is concerned, things are similar to what we saw in 2023, but the mix of data, the mix of growth is somewhat different in terms of Euroland and UK growth is stronger in 2024 than we saw in 2023, and growth in the likes of India and China and also Japan is weaker. Surprisingly, growth is predicted stronger in 2024 in the US. That said, I think that given some of the numbers that we're getting out of the US recently, that might be downwardly revised when we get the next derivation of these forecasts in July. One point that I would highlight is that there are significant headwinds to UK economic activity from things like the election, from things like the fact that interest rates haven't been cut in line with expectations. And although we have seen some weakness in consumer spending from the retail sales numbers, the numbers overall in the GDP figures for the first quarter were remarkably robust. And not only that, we also saw a rise in the savings ratio. So just bear those in mind, because I think there are some anomalies within these data releases that are worth further interrogation. If we move on to the next slide, what does inflation look like? Well, the first thing to highlight is the title of this is that the headline consumer price inflation hit 2% in the May reading, but we're also seeing a fall in other readings as well. So we saw Euroland inflation falling back. We've seen US inflation falling back, having overdone the readings versus expectations. So it exceeded expectations in the US for a few months, but we are seeing a downward trend now resuming as far as inflation is concerned. Remember, this is inflation, so it's the rate of change of prices, not prices themselves. So it's not prices falling, they're going up more slowly. But there is one factor that we've heard recently from clients that could be a cause of concern for them, which is the renewed increases in shipping costs. And it's something that I've raised with a number of my colleagues, and a number of my colleagues have raised with me. Shipping prices in some cases have increased eightfold over the course of the last 8 or 9 months. So that could stall the progress of inflation going forward. So just watch out for that, whether or not that starts to impinge on additional improvements in the inflation rates across these 3 major jurisdictions. If we move on to the next slide and we look at interest rates, well, we've had the first cut in interest rates from the European Central Bank. That hasn't been followed by the Federal Reserve or the Bank of England just yet. But the Bank of England, the case for interest rate cuts, I think, is growing by the day. And therefore, I think that without the uncertainty around whether or not the Bank of England would decouple from the Federal Reserve, I think this would be a higher probability than the markets are attaching to it. We still think the Bank of England will cut in August, taking interest rates down to 5% from 5.25%. But the earliest that the Fed will cut is in September. We're still of the opinion as well that the UK will cut by 3 times this year. With regard to the Fed, it's a toss-up between 1 cut and 2 cuts from the Federal Reserve, because they obviously have that tricky thing in the middle of all of this, which is a presidential election in November. For the European Central Bank, we think they'll follow suit with the Bank of England in terms of 3 cuts this year, with the second cut coming in September. Worthwhile noting that a lot of other central banks are not waiting for the Federal Reserve, and the latest of these was the Bank of Canada, who cut their interest rates by 25 basis points at their June meeting. And the forecast for financial markets. The one thing I would hasten to emphasize straight away is that the markets have taken a very sort of relaxed view in terms of this UK general election, whereas when we were seeing the polling data out over the French lower house election, and it looked like National Rally were going to get a much larger vote share than they ended up getting, that did have a negative effect on the euro's value. There hasn't been the same sort of transference of concern or indeed optimism around sterling because of the UK election. So very much the case that the markets are relaxed, but they're neither optimistic nor pessimistic about the outturn. In terms of one of the other big movers that we've seen since the last webinar, we've seen dollar yen moving back above 160. The yen, it continues to be under pressure. It's one of those things where they really need to stop saying that they're going to do something and actually do something if they are to arrest the yen's drop in valuation. We've also seen that then leak into a weaker Chinese renminbi. Offshore Chinese renminbi against the dollar is now trading above 730 once again. So just watch out for those things, because there could be additional weakness in the yen and the renminbi to come. But of course, the weaker that the renminbi is, the weaker that the yen is, the more likely it might provoke some sort of intervention response from the Bank of Japan. So there's the potential for volatility in that particular currency pair. That's really it in terms of my presentation. There's my disclaimer, similar to Piers in length, and we look forward to speaking to you again in early August, when we'll look again at how macroeconomic and market trends have changed between now and then. Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.